Welcome to Chapter 5. Having looked at cost classification in the previous chapters, we're now going to look at how to account for the main types of costs. And we're going to start here in Chapter 5 by looking at how to account for materials. In this chapter, we'll specifically look at inventory, and we'll look at some of the calculations that could come up in the exam in relation to inventory levels and inventory valuation. Let's look at it in more detail via your summary diagram over the page.
This is going to be tested in section A of the exam, and it could require you to be aware then of the procedures and documents that are needed when ordering the materials and how to record those purchases in the accounts. And through calculations, it could be looking at the monitoring of inventory levels, and we're going to be using some techniques for the EOQ, the economic order quantity, and for production, the economic batch quantity. We'll also have some formulas to learn about at what point to reorder and what the minimum and maximum levels of stock should be. We're also going to consider how we value our inventory using three methods: FIFO, first in, first out; LIFO, last in, first out; and an average method of valuation. Having learnt how to classify different costs, the next step is how to account for them. In Chapter 4, we will be looking at how we're going to account for materials, and that starts off with the process of inventory control, and that starts off with the paperwork. So what we need to do is understand what documents are going to be needed when materials are required. So a department then is looking for new materials, then they're going to start off with a purchase requisition document, which is going to request the items required for production. The stores department will pass that to a purchasing department, who will raise a purchase order, which gets sent out to the supplier to actually order the goods, the accounts department so that they are aware when the invoice comes in that the goods were ordered, and the stores department so that they know what is on its way. Once the goods arrive then, a goods received note or a delivery note will accompany them, and that will come in and be signed off in the stores to confirm that the right items and they're not damaged have arrived. That will be sent to the purchasing department, who tie it back to the purchase order, and to the accounts department, who will agree the purchase order and the goods received note and the invoice before the invoice ultimately gets paid. When the materials are purchased then, we need to make sure that we have a record of them in the company's accounting books. And we're going to do that through a debit to the material inventory account and a credit either to cash or to the creditors, depending on whether or not they're paid for immediately. When those goods then are issued to production, we need to credit that inventory account and debit the work in progress account. And what you can see then is that we end up with the materials inventory account down here. So when the materials come in, they go on the debit side, and when they go out, they're to production, they're going to go on the credit side. One of the main reasons then for keeping all of these records is so that we've got an accurate idea of what is actually held in inventory. And so periodically the company is going to need to carry out a check to make sure that the physical inventory matches those shown in the accounting records. And quite often that will be referred to as a stock take, especially if it's done on a periodic basis, or it could be a continual check of the inventory levels. If we're thinking about making an order then and wondering what we need to think about the free inventory balance. And the free inventory balance then will be necessary to obtain a full picture of what the organisation has available to it, because free inventory then is what is actually available as opposed to what might be on the shelf. So we start off then with what's in inventory, what's on the shelf, and then we need to consider materials that are on their way from the suppliers, but take off anything that's already been requisitioned, that's already been requested by a department, And that summary balance then is what we actually have to use. Before we look at how to account for all the different costs then, we need to think about the reasons why inventory is held. You can think about this then from your own perspective perhaps, and think about an example such as, why do you hold tea bags? Now, I've got lots of tea bags in my cupboard and I buy them in a box. And the reasons for having a whole box of tea bags, although common sense, are also really the reasons why businesses are going to hold inventory. So the first one then is in case I want a cup of tea, so to basically ensure that demand can be met and that there won't be any stock outs. So I'd feel quite grumpy if I couldn't have a cup of tea in the morning. It's also going to be for convenience, so it's much easier than having to pop to the shops every single time I want a drink. Holding inventory then is also convenient, so it's better than having to go shopping every time you want a cup of tea. It can provide a buffer between the processes, and it can also be used to overcome any shortages in supply in the future, so if there was a shortage in tea leaves. The other thing is that it's cheaper. Buying in bulk means that you're often able to get a discount, and it means that you have got enough stock to absorb fluctuations in demand and in usage. So having a box of tea bags just means then that there can be fluctuations in demand, so unexpected visitors can be dealt with and provided with a drink. There are also some costs of ordering and holding. So holding costs then will be the actual Given what I've said in A about the reasons then for holding inventory, why don't we have the year's supply of tea bags? Well, one of the reasons is going to be storage. There would need to be additional space in the kitchen if you're going to do your year's shopping. There's also the finance charge, so interest charges. You might have to borrow the money in order to purchase the items. There would be costs to do with insurance, especially if there were going to be shortages. And there's also then the risk of theft or damage or some kind of obsolescence. And obviously it depends on the type of inventory being held, how high those risks are. Equally though, we don't want to place an order every day, so we need to think about the costs of ordering. Those could be the clerical costs. They could be the costs then of administering the order, so actually placing the order and checking the goods received, and also the transport costs. So with food, that might be the cost of perhaps an online shop. So what we need to do then is think about how we can hold an appropriate level of inventory and make sure that we don't have too much inventory so that those holding costs are too high, but equally we don't want to be popping out to the shops every 5 minutes because that's going to increase the costs of ordering. When managing our inventory, we can use our historic records to work out some control levels. And it's important then that you learn these formulae because they're not given to you in the exam. So the first one is the reorder level. And that's the point then at which we're going to order some more. So that's the point at which I'm going to look in my jar of tea bags and think I need some more. And it's set so that in theory you shouldn't be able to run out of any inventory because it assumes that the maximum use per day occurs and it takes as long as possible, or the longest lead time, for new inventory to arrive. So you're going to reorder then at the point at which the maximum usage per day times by the maximum lead time. The next one we need to consider then is the minimum level, And this is the level then, with all things being equal, that inventory is not going to fall below. It's going to act as a warning to management that inventory is very low, and following on from that is the risk of stockouts. So the minimum level then is that reorder level that we've worked out above, multiplied minus the average usage per day multiplied by the average lead time. So that's what I mean by normally full. Finally, the maximum level then is the level by which you wouldn't expect inventory to rise. And this is a warning then that you've got too much stock, which is uneconomical because of all those holding costs we mentioned. The maximum level is the reorder level plus the reorder quantity. So what we're assuming is that we've actually made the order and those goods have come in. And we're assuming that we use the minimum amount of day and that they've arrived in the shortest possible time. One other thing to work out then is average inventory. So how much on average will you have in stock? Well, it's your minimum amount plus half of the reorder quantity if we assume then that our usage is constantly fluctuating. One of the ways we can calculate the reorder quantity, i.e. how many to order once we get to that reorder level, is to use the economic order quantity formula. In example 2, we're going to work through some data for a component, working out the reorder level, the minimum inventory holding and the maximum holding. In the exam in section A, you won't get questions where one scenario relates to multiple areas. But here it's useful while we're learning the formulas to apply the same numbers to different questions, because you could be given this information and asked to calculate one of those three things from it. So we start off then with the reorder level. And with the reorder level, we need to make sure that we've learnt the formula. So that's the maximum usage per day multiplied by the maximum lead time. And the point then of this reorder level is if we assume that we use the maximum amount per day, which here is 2,250, and it takes the maximum number of days, which is 16, we're still going to avoid a stock out. The reorder level here then is 36,000 units, which is answer B. In 2 then we were asked to work out the minimum inventory holding below which inventory should not fall. So the minimum level is that reorder level less the average usage times by the average lead time. And the clue then that we're using average usage and average lead time is we're saying that it should not usually fall below. So not that it could definitely not, but it's not usually going to fall below. So here we've worked out the reorder level to answer part 1, but it might be that for one question you first of all have to work out the reorder level and then apply it to the formula for minimum inventory. And the average usage per day is the average then of the maximum and minimum. So 3,250 divided by 2, our average is 1,625, and our average lead time is 24 divided by 2, so it's going to be 12 days. The 36,000 less 19,500 gives us 16,500 units. Finally then we're looking at the maximum inventory holding above which it shouldn't usually rise. And the formula here then is the reorder level again plus the reorder quantity. So we're going to reorder when we get to 36,000 and we're going to order 14,500 units. So that's what we're going to have. but we have an assumption then that from the point at which we reorder, we'll actually be using up stock. So we need to take away from that the minimum usage times by the minimum lead time. So if we assume then we've used as little as possible. So the minimum usage then is 1,000 units per day, and the fastest it could come in is 8 days. So we assume then that the minimum we would use between placing an order and it arriving is 8,000 units. So we're going to order when we get to 36,000, but we'll have used 8,000 by the time we place that order as a minimum. Sorry, by the time that order arrives as a minimum, and we're going to receive 14,500 when the order is placed. So the maximum level of inventory that we should ever have is 42,500 units, which is answer C. We've talked about costs associated with inventory then and the costs that involve holding it, but now we need to think about how these are going to be calculated, and you need to learn all of these. The most straightforward then is the purchase cost, and unless we've got bulk discounts available, that's not going to be affected by our stock policy, and that's going to be the purchase price, and we multiply by the annual demand because we always look at the costs associated with inventory on an annual basis. The ordering costs though will be affected by inventory if we're charged a fixed amount per order. So what we're going to do is we're going to look at what our ordering costs will be if they're affected by the number of orders. If they're affected by the number of units, then they're going to be dependent on sales levels. So the ordering costs then will equal the cost per order times by the number of orders. And the number of orders then is the annual demand divided by the number that we're ordering per order. Finally then we've got the holding costs. Some of the holding costs then are going to be fixed, things like warehouse rent, and won't be relevant to inventory policy, but some will vary according to the number of units held. For example, things like insurance per unit. So with the holding costs then, we look at the cost of holding 1 unit in stock for 1 year, and we multiply that by the average inventory for the year. So the average inventory for the year then will be the amount that we order at a time divided by 2 plus any buffer that we have, and we need to multiply that by the cost per unit. And one of those things then that's going to contribute to the holding cost then is the cost of capital, that opportunity cost from having the money tied up during the year in inventory. Worked example 1 just illustrates then the holding costs for 1 unit for 1 year. So we've got a purchase price of $10 and delivery costs of $2 per unit, and the firm's cost of capital is set at 15% per annum. So the cost of getting 1 unit into inventory in the first place is $12, and if we multiply that $12 by the cost of capital, that gives us $1.80. So what we're saying then is the cost of keeping 1 unit in stock for 1 year through financing and cost of capital is $1.80. You might now be thinking then, well, how many units is it appropriate to order at a particular time? The EOQ model then aims to balance the holding costs and the ordering costs. So it's a mathematical model that you're given in the exam, the formula you're given in the exam, to calculate the amount of inventory to hold so that you minimise the holding costs, the ordering costs and purchase costs. And what we need then is to assume that demand is constant, delivery is either instantaneous or the lead time is always constant, and there are no discounts, so we pay the same regardless of the number of units that we order at a time. And in order to use this formula, what we need to do then is you know the purchase cost, the annual demand, which is why I said we talk about costs per annum, and we also need to know the fixed cost of an order, the cost of holding 1 unit for a year, and the number of units ordered. and these are denoted by the letters here. And what we've got down here then is the EOQ formula. So the quantity to order is equal to 2 times by the cost of placing an order times by the annual demand divided by the cost of holding 1 unit in stock for 1 year, square rooted. And the good news is that that formula is given to you in the exam. However, it is only the formula that is given to you, so you need to learn those definitions, and you need to remember that this demand figure, for example, is annual demand. And the total costs then associated with the EOQ then are going to be the total purchasing costs, so the purchase cost times by the annual demand. It's going to be the ordering costs, so the cost of placing an order times by the annual demand divided by the quantity ordered at any one point. So that's going to give you the number of orders per year, and the cost of holding 1 unit in stock per year times by your quantity ordered divided by 2 to give you your average quantity. So what we're going to do then is say that our total costs are equal to our ordering cost plus our purchase cost plus our holding costs, and you need to learn the definitions for each of those. In example 3, we're going to be working out the EOQ, and we're going to be working out the costs in part B associated with that order quantity, and then we're going to work out what the holding costs are depending on the number of units that we actually order. So if we're looking at the EOQ, the formula is 2 times by the cost of placing an order, and the cost of placing an order is $32, times by the annual demand. The demand then given to us in the question is per month, so we need to multiply that by 12 to give us the annual demand. So we've got 2 times by 32 times by 1800 times by the cost of keeping a unit in stock for 1 year. Well, the cost of 1 unit is $25, and the cost of capital is 18%. The cost of holding 1 unit in stock for 1 year is going to be $4.50. And we need to square root all of that. So make sure you're happy locating the square root button on your calculator. The economic order quantity is 160 units. If you didn't get 160, make sure that you're popping all of that formula into your calculator correctly and you've got your brackets in the right place. 160 units is the economic order quantity, and that's the best quantity to order to minimise the holding costs and to minimise the ordering costs. What are the total costs associated with this order? Well, for our total cost then, we've got our purchase costs of $25 per unit for the year. We've also got then our ordering costs, and our ordering costs are $32 per order, and during the course of the year, if we want 1,800 units and we order 160 at a time, we're going to make 11 1/4 orders. And we've also got our holding costs, and our holding costs then were $4.50 per unit, and on average we're going to hold 80 units. So here then my holding costs are $360 per year. My ordering costs are also $360 per year, and my purchase costs are going to be $45,000. So the total costs then will be $45,720. Now, if you notice that the holding costs and the ordering costs are the same, that's not a coincidence. That's what the formula is doing. It's setting those equal. So we're going to have those costs minimized, and we'll see why in a moment. If we work out the holding costs and the ordering costs, if we deviate from the EOQ and order 200, 600 or 1000 units. So if we start off then, if we order 200 units, well, our holding costs then are going to be $25 times by 0.18, so the 450, times by my average inventory of 100 units. So my holding costs will be $450. The ordering costs then, well, 1800 divided by 200 is going to mean we make 90 orders during the year, rather 9 orders during the year, and the cost of placing an order is $32. So my whole ordering costs will be $288. And what you can see is that total is 738, and that's marginally higher than the EOQ. If we carry on working down the table then using the same principles, we'll see that the holding costs for 600 units, on average we're going to have 300 units at $450, so my holding costs will be as high as $1,350, and the ordering costs, we're going to make even fewer orders. If we order 600, we're going to make 3 orders a year, so we're only going to have $96 of ordering costs. So that's a total of 1446. Finally, if we order 1,000 at a time, well, on average we'll have 500 units at $450, so that's 2,250. We're only going to need to make 1.8 orders per year though, so our ordering costs will be very low at 57.6, the lowest. So what you notice then is the more units you order at a time, the lower your ordering costs, but what you do notice is that you end up with an increase in your holding costs. And what we can see is that holding cost increased is proportionately more than the reduction in the ordering costs. So my total costs will start to rise as I hold more than the EOQ. And you could look at every possible combination of units to order, but the formula for the EOQ, and you don't need to worry how that's derived, will always give you the minimum one. It's going to give you the one where the two are in equilibrium, so the holding costs are balanced with the ordering costs. And that's why in our example the holding costs and the ordering costs were the same at 360. So far then we've assumed that the purchase price is constant, but it might be that you get a discount if you're going to buy in bulk. And we need to take that into consideration when we're determining the best quantity to order. So the EOQ gives us the optimal quantity to minimise holding and ordering costs, but it doesn't take into consideration bulk discounts. So what we need to do then is to calculate the total costs, so purchasing, ordering and holding, at each of the discount bands to find the lowest total cost. And we've got an approach here that we can use step by step, which we'll do in an example. So what we do then, first of all, we calculate the EOQ as normal, but we will then need to recalculate it if it falls within a discount band. And the reason for that is because the holding costs change if it's a percentage of the purchase price and the purchase price falls. So what we'll do then is we'll calculate what those annual holding costs will be using the EOQ, and then the revised EOQ that is, and then we'll calculate them at the lower boundary of each discount band above the EOQ so that we can choose the quantity which minimises cost. So these are the steps to work through, but they're much easier to see through an example. So that's what we're going to do now. What we're going to do in example 4 then is we're going to use the same information that we did in example 3, that basic EOQ. And what we're going to do now then is assume that we've got some discounts and work out what's the minimum cost we can have if we optimize our inventory holding policy and ordering policy. So what we're doing is we're getting a discount then of 1% if we order more than 150, a discount of 2% if we order 300 or more, and a discount of 4% if we order 800 or more. So what's going to happen then is the purchase price is going to fall as these discounts come into play. Now the EOQ that we calculated previous was 160. So if we're going to be ordering 160 units at a time, we're going to get this 1% discount. So what we need to do is to work out the revised EOQ as the purchase price will have decreased from $25 per unit. It will have decreased by 1%. So my revised EOQ then is 2 times by the cost of placing an order times by the annual demand. And this time it's the cost of holding 1 unit in stock, but at that lower cost. So the actual purchase price now is going to be 1% lower. It's going to be $24.75. So the holding cost per unit is now going to be $4.455. Remember, we need to square root that to work out the EOQ. So 2 times 32 times by 1,800 divided by my 4.455, and then square root the answer, and that's going to give me 161 units, or 160.8 rounded up to 161 whole units. So with a discount of 1%, we're going to order 161 units. What's that going to do to our costs during the year? Well, the purchase cost is going to be $24.75 per unit, because that's applying the 1% discount. Multiply that by the 1,800 units, and the purchase cost will be $44,550. The ordering costs then will be the number of orders, and if we're ordering 161 at a time, that's going to be just over 11 orders at a cost of $32 per order, so $358. And the holding costs then will be the cost of holding 1 unit in stock for 1 year times by my average stock levels. And the average stock is 80.5 times by the holding, and that gives me 359. Slight difference between the ordering cost and the holding cost then due to rounding. The total cost here, $45,267 to the nearest dollar. To get a 2% discount then, I need to order 300 units at a time. If I order 300 units at a time, I'm going to get a discount of 2%. 25 times by 0.98 means that the cost will be $24.50. So the purchase price is going to fall, and I'm going to end up with a purchase cost of $44,100. Ordering cost is also going to fall because I'm going to be ordering fewer units. So I'm only going to be making 6 orders. So the ordering costs will be 192, but the holding costs are going to be higher because we've got more units. So there'll be $24.50 times by the cost of capital times by the average number of units in stock, which is 150. There'll be 662. So that's going to be total costs of $44,954. Finally, then we need to look at the discount to get a 4% discount, we need to order 800 units at a time. To get a 4% discount then, we're going to be paying $24 per unit. So 1,800 ordered during the year at $24 will give us the lowest purchase cost. That's $43,200. The ordering costs then, when we're ordering 800, will be 1,800 divided by 800 multiplied by 32. So that's going to give us ordering costs of $72. The holding cost then will be $24 per unit as the purchase price multiplied by 0.18 times by the average level of stock, and the average level is 400 units. So that gives 1,728, and that gives total costs of 45,000. Exactly. So what you can see then is that here it's better to order 300 units at a time. So despite the fact that you're paying slightly more for the units than you are if you order 800 at a time, that saving then in the purchase price is eroded by the fact that the holding costs are much higher if we order 800. So what we need to do when we're making the decision about inventory levels is consider all of the different costs. A variation then on the EOQ is the economic batch quantity, or EBQ. And this is when the inventory is replenished gradually to match production rates rather than instantaneously or with those constant lead times. What we want to do then with this approach is minimise administrative costs, as well as reducing the costs of holding inventory, and also make sure that we've got inventory supplies if the company is manufacturing inventory for its own use rather than ordering from a supplier. We can also use EBQ if the supplier is willing to deliver gradually. So what we've got then is a company perhaps wishing to order 500,000 components to secure supply whilst receiving delivery to match the weekly production of demand for the components of only 5,000, because we've got limited space in the warehouse. And that demand then, that weekly demand, is the production rate or the delivery rate, and that's denoted by R in the formula. So the formula for the EBQ is very similar to the EOQ, except we're recognising that we never hold everything in inventory. And the formula is given to you in the exam, and it's very similar. It's 2 times by the cost of placing an order or setting it up, the machine, times by the demand in the time period. But note, this is demand in a time period. It doesn't have to be a year like the EOQ. Then we've got the cost of holding a unit for that time period. And then this is the bit that's different. We've got 1 minus the demand divided by the production or delivery rate. So we're recognising then that it's not all going to be produced instantly. One of the uses of this then is working out what's the optimum number to produce or order. What we need to learn then is the holding costs associated with this, and it's similar to the EOQ. It's the average quantity times by the cost of holding one of those units, but we need this added extra of the 1 minus the demand divided by the production rate. Again, something like this is very useful to use some numbers with it, and that's what we're going to do now. Berry then has capacity to make 800 cakes a week, but the demand from customers then is only 600 per week. Setup costs for each production run are $5.40, and the cost of holding a unit is 5 cents per week. So what we need to do then is to work out the EBQ using the formula that's given in the exam. So the EBQ formula is 2 times by the cost of placing an order times by the demand divided by the cost of holding that unit, in this case for a week, multiplied by 1 minus the demand in the period divided by the rate of production, square rooted. So 2 times by the cost of setting up the machine, which here is 540, times by the demand. Well, the demand then here is 600 cakes per week. The cost of holding a cake then is 5 cents. And we need to multiply that by 1 minus the rate of demand divided by the possible rate of production, square rooted. So be very careful putting this into your calculator. The way I'd advocate doing it then is 6 divided by 8, and then 1 minus that answer, the recall on your calculator, multiply that by 0.05, and that will give you the bottom of the formula. And then put in brackets on the top, 2 times by 5.4 times 600, close brackets, divide by your answer from the bottom, and then finally square root the whole thing. And you should end up with an EBQ of 720. That's 720 units. What are the total weekly holding and setup costs associated with this if Berry wants to minimise costs? So the holding costs then are the average quantity multiplied by 1 minus the demand divided by the rate times by the cost of holding 1 unit. So the average quantity then here is going to be 720 divided by 2 multiplied by 1 minus 600 over 800 multiplied by the cost of holding 1 cake for 1 week. The holding costs are $18. So for the holding costs then, we're going to be looking at the average quantity, so 720 divided by 2 multiplied by 1 minus the demand in the period divided by the rate of production multiplied by the cost of holding 1 unit for 1 year. So that's 720 divided by 2, because that's how many we're going to make in a batch, multiplied by 1 minus 600 over 800 multiplied by the cost of holding 1 unit in stock for 1 week, which equals 450. Now the setup costs, you should probably be aware that these are also going to equal 450, but let's just check. So the setup costs then are going to be the number that are demanded divided by the number that we're producing multiplied by those setup costs of 540, and that does equal 450. Example 6 then is a narrative question on the face of it. So what we have to do then is look at what would be the effects on the EOQ and the total annual holding costs of an increase in the cost of ordering a batch of raw materials. However, although there are no numbers in the question, making up some numbers here will help you to answer the question. So rather than trying to learn what happens in every particular circumstance and running the risk that you think the question is the same as one you've seen before, but actually it's the cost decrease rather than increase, it's much easier to use some made up numbers. So let's imagine then here that the cost of placing an order is going to be $5 and that the demand is going to be 1,000 and my holding costs are going to be $0.25 per unit, or 25 cents. So what I'm going to do is I'm going to use my made up numbers and work out the EOQ for them. So 2 times by the cost of placing an order times the annual demand divided by the cost of holding 1 unit for 1 year, square rooted. And those numbers, I've completely made them up, but I chose them because they give me an EOQ of 200. And obviously in the exam, it doesn't matter if you make up something that doesn't come to an EOQ that's a whole number. What I'm going to do now then is I'm going to say, right, okay, well my ordering costs need to go up. So what I'm going to do is I'm going to change my ordering costs to 10. So 2 times 10 times by 1000 divided by 0.25 square rooted gives me 282. So what's happened is my EOQ is going to be higher. So I automatically know that now it must be A or B. What's going to happen to the holding costs? Well, I've gone from holding 200 units to 282 units as the EOQ. So what's going to happen then when you hold more units is that the holding costs are also going to be higher. So the answer to this question is going to be B. The final thing we're going to be looking at here then is methods of inventory valuation. So FIFO then assumes that we're using a first in, first out. So what that assumes then is that the last units to be purchased are going to be sold last, and those that you've owned the longest are going to be sold first. And that makes sense for lots of products, and that's actually the method that the standards require companies to use in their published accounts. And you can assume that for things like food stuff, then it would absolutely make sense to use the cheese that you purchased first before using the stuff that you've purchased today. LIFO then is an alternative where we're saying that actually we're going to use the most recently purchased items first. So last in, first out. And there are certain circumstances where this is going to be appropriate. So if you've got a big heap of coal, then you're going to use the items off the top rather than digging right to the bottom. And the same would be true of things like petrol in your car. Finally then we've got AVCO, or average cost, and what that does is it calculates a cumulative weighted average of all of the units and uses that to value those units issued or sold. So what we have in the worked example then is information about units purchased at different times during the month of March and also sold at different times. What you'll notice then is the first lot that we had in stock we bought for $2, subsequent purchase was at $2.10 and then at $2.30. So the cost then of inventory is rising throughout the month. What we need to do then is, when we're using the different methods, is to think about these sales on the 5th and 20th of March and work out which units it's going to be. So when we're going to be using the FIFO method, we assume that those 50 that we sell on the 5th of March are part of the opening inventory that we had. Then the ones that we sell for 150 are going to be those remaining 50 and some of these 300 here. And you'll see that that is represented in the FIFO workings. So what we've got then is the ones that were issued on the 5th of March were the $2 ones, and the issues on the 20th of March were 50 units at $2 and 50 units at and 100 units at $2.10. When it comes to working out the value of our closing inventory, we've got 200 of the units purchased on the 2nd of March left and 100 of the units purchased on the 17th of March. So that gives us a closing inventory valuation of 650. Using LIFO though, we are assuming that those that are sold on the 5th of March were those purchased most recently, so they've got a higher cost per unit. And again, when we look at the sales on the 20th of March, the first 100 sold will be those purchased most recently on the 17th of March, and the other 50 will come in at 210. Those will be those that we purchased on the 2nd. What that means then is that the inventory value at the end of March will be lower because we're going to be valuing the 200 that we originally purchased, the $200 worth that we originally had and didn't sell at $2 per unit, and the remaining ones from the 2nd of March that we've not sold. So we end up with a value of 620. With the average one, we're going to work out an average inventory valuation after every transaction. So when we've bought some more on the 2nd of March, we're going to work out what the average cost of those 400 units is, and it's just over $2, and that's what we'll use to value the issues on the 5th of March for those 50 units. Then we buy some more on the 17th, work out a new average valuation, and use that for the 150 that are issued on the 20th of March. And as you would expect, the AVCO inventory valuation is between the LIFO and FIFO versions. So we end up with different inventory valuations, and what that means then is we're also going to end up with different profits. Because profit, remember, is going to be our sales, which is constant, $5 per unit, so across all three methods, $1,000, less the cost of sales. So what we've got here then is under FIFO, we've got the highest inventory valuation when prices are rising. So when prices are rising, the FIFO method of inventory valuation gives the highest closing value and will give the highest, LIFO will give the highest gross profit. In this chapter, we've been looking at how to account for one of our very important costs, which is materials. We began by thinking about the processes then involved in inventory control. So thinking about the processes in which the business goes through for ordering, purchasing, getting the goods into the stores, and then issuing those stores into production and controlling their levels of inventory. In this paper then, we're mostly concerned with these ideas about controlling the levels of inventory. So after a quick look at the documentation for the ordering, receipt and issue, we moved on to the monitoring of inventories. Now obviously we're not going to do a stock count during the exam, either a periodic or a perpetual one, but what we might have to do is some calculations associated with inventory. And you need to make sure that you've learnt the formula for these three critical control levels. So the reorder level, the minimum level and the maximum level. The costs associated with inventory were also very important because when we're deciding how much to hold, we need to balance all of these off. So there's the obvious purchase costs, but there's also the holding costs, the cost of placing an order, and the costs associated with running out of stock, such as inconvenience or loss of customer goodwill. In an attempt to balance then all of these different costs, we used a formula called the EOQ, or the Economic Order Quantity Model. And this is the order quantity that minimises your total inventory costs by setting the holding costs exactly equal to the ordering costs. And the formula that does this is given to you in the exam on the formula sheet. We dealt with discounts then if we're making a bulk order, and what we needed to do then is work out the total costs at each discount band in order to work out the best order quantity when there are discounts. So the EOQ is still the starting point when there are discounts, but there are additional calculations to carry out. We also looked at something very similar called the Economic Batch Quantity, or EBQ. Also given on the formula sheet. It's a modification of the EOQ, and it's used when we have a gradual resupply or gradual production rather than deliveries being made at set points. Finally then, we considered 3 different approaches to inventory valuation: first in, first out, or FIFO, last in, first out, or LIFO, and a weighted average or average cost of inventory valuation. And we saw in the worked example how that can have a different impact on your profit valuations, the choice of inventory valuation. And remember that the standards say that you must use a FIFO, even if you decide to use something different in your management accounts. So therefore FIFO is the most widely used.